Hello, my name is Rob Montgomery, and welcome to Anatomy of a Dental Deal. The goal of this presentation today is to give you an overview of what to expect when you are purchasing a dental practice. Now, I'm going to talk about the main aspects and issues involved with a practice purchase, but understand that every deal is different and that there are a number of other issues that can arise. I'm an attorney with the law firm of Robert H. Montgomery III, Esquire, PC. We represent primarily dentists with their business legal matters, things such as practice sales and acquisitions, real estate acquisitions and leases, LLC and professional corporation formations, employment agreements. We help with financing, and from time to time, we also litigate matters. Before we begin today, I want you to be aware that this presentation is for informational purposes only. Nothing in the slides or the audio portion of this presentation should be considered legal advice. The transmission and viewing of this information does not create an attorney-client relationship, and as with any important business transaction, you should consult with legal counsel before proceeding with the purchase of a dental practice. And now on to our program. As you begin the process of purchasing a practice, it's important to assemble the right team. That team should include at a minimum an attorney and an accountant, but it also may include other consultants. It's highly advisable to work with professionals who are familiar with and have experience in the dental industry. Avoid the trap of using people that are friends of friends or relatives or people that could do it cheap or even free. There's a cost associated with free. At the end of the day, you'll be happy that you worked with people that understand your business, have had experience with these transactions, so they can guide you better along the process. This next part may seem intuitive, and it probably should be. However, it's not always the case. So certain professionals should be doing things that are within the scope of their profession. So lawyers should be preparing and negotiating agreements. CPAs should be performing valuations. Really try to avoid people who are wearing multiple hats or, getting out of their lanes. For example, CPAs that are preparing legal agreements, or lawyers doing practice valuations, or even consultants doing valuations. Another thing that comes up a lot of times in the dental industry, which is a concept that kind of gets borrowed from the residential real estate world, which is dual agency or dual representation. Now, those terms are really, in my opinion, fiction. It's impossible to truly represent both sides of a transaction. You can't serve the best interest of the buyer and the best interest of the seller at the same time. And anybody that tells you that they can is really not being straight up with you. Imagine a baseball game where a pitcher pitches for both teams. Now, that might be something that when their kids are playing baseball or starting off, there can be a steady pitcher, or a grown-up is the pitcher for both teams. But you're not going to find in the major leagues somebody that switches uniforms or switches hats between innings and goes out and pitches for the other team. While that may sound funny, that's exactly what we're talking about when we're talking about dual agency and dual representation. And we have a little picture here of the dual agent in and it's important to keep in mind that these people really represent themselves, and they're not representing one side or other of the transaction or even both sides of the transaction. And when you deal with people like this, if you have to, because sometimes if you're purchasing a practice and it's listed with a broker who offers themselves up as a dual agent or a dual representative, you really need to carefully scrutinize the agreements that they're producing or circulating and the advice that they're giving, which gets us back to something we talked about a few moments ago, which is it's really important to have your own people, your own lawyer, your own CPA, who are only interested in your best interest, not in the interest of seeing a deal go through, regardless of whether or not it's best for you. A lot of these people also try to, I think, scare people and tell them that, well, if you get lawyers involved, they're just going to fight and they're going to kill the deal and they're going to run up fees. And that really doesn't need to be the case. I mean, a good lawyer works collaboratively with the other side, and they try to get things done in an efficient way that's a win-win for both sides. But that doesn't mean that they're not looking out for the best interest of the client. So again, really important to work with your own professionals that understand your business and seek their advice and let them guide you through the process. Let them look out for your best interest. Now, once you find a practice that you like and you think you might be interested in purchasing, the next step is to evaluate that practice. Now, this is something that should be done together with a CPA that, again, has experience in the dental industry. And there are going to be a number of things that you're going to want to look at with that professional and things that you're going to want to request from the seller. And here's a list of kind of the typical items. So tax returns, profit and loss statements, balance sheets for the seller. You're going to want to see information that confirms or demonstrates the number of patients and the demographics, the patient demographics for the practice. Patient census is they're also often referred to as. Uh, Another one that's very important is whether the seller participates as an in-network provider with insurance plans, and what do those fee schedules look like? Does the practice accept Medicaid? When you're looking at fee schedules and revenue, it's easy sometimes for a practice to have a lot of revenue and have a high volume if they're not charging people a lot of money. Just because a practice grosses, that means brings in money, a lot of money, doesn't necessarily mean that that practice is profitable. So that's something that you need to be aware of and work with your accounting professional on. You're also going to want to look at staff salaries. Are there people that have been working for the practice for a long time who are grossly overpaid, such that it's going to be difficult to continue to give them raises and keep them incentivized. And the last thing on this list, which is important for us, is whether or not there are employment agreements if there are associates in the practice, and do those associate employment agreements contain enforceable restrictive covenants? And can those covenants be assigned? And what we're talking about here are covenants not to compete or non-solicitation covenants. So you don't want to purchase a practice that has an associate working for it where the day after the purchase, the associate's able to go out across the street and hang out a shingle and take all the patients. Similarly, when you're trying to protect the patient population after the practice purchase and in the transition stage, you want to make sure that those restrictive covenants can be assigned. That means, can they be turned over to you such that you are able to enforce those restrictive covenants if that associate breaches the agreement. So whether or not you hire that associate after, you don't want that associate, say 3 weeks after you've purchased the practice and they're no longer working for you, to go out and compete against the practice. Now, one more thing that's a little more sort of touchy-feely, but it's not really legal or economic, but it's also important, which is look for practices that are similar to your vision. What I mean by that is practices that are operating in a way that you think you want to operate your practice at some point in time. A lot of things, a lot of times people look at practices and they say, well, I'm going to buy this and then I'm going to change everything. If you're going to do that, make sure you're purchasing a practice for a price that reflects the fact that all these things are going to be changed. Because if what you're buying is something that needs total overhaul immediately after the closing, you may want to think about whether or not that's the right practice for you. Because among other things, you've now paid for something that's no longer in existence, which it may have needed some upgrading, but it's also difficult to transition patients from the seller to you if those people are no longer comfortable in the practice or don't recognize things and feel like everything's different, like they've gone to a different place. Now, during this part of the process, when you're evaluating the practice, this is the point in time where you really want to be trying to arrange for and shopping for financing for the purchase. While the practice valuation process is proceeding, and really at the tail end of that process, is when you want to start negotiating the purchase price. My philosophy with purchase price negotiation is that if a client is working with a good dental specific CPA who is helping with the due diligence and really has their arms around the numbers of the practice, has a command of the sort of the valuation issues, that they're the ones that should be taking the lead in the purchase price negotiations. I think whenever you get into purchase price negotiations, or frankly, any negotiations of any sort, knowledge is key. And to be able to have facts and sound reasoning for your position will always be a more effective way to negotiate. So if people are just throwing out numbers, 500, 600, 550, 575, it starts to look like an auction or you're horse trading. Whereas if you have the ability to say, I think it's worth 550 because the practice has seen declining revenue over the last 3 years, and some of this overhead is a little higher than it should be. So 550 we think is the right number as opposed to 600. That's a much more compelling argument, and I think that you'll find that you'll be able to advance your position more when you approach things as opposed to just throwing out numbers randomly. Something that we like to tell our clients when they're negotiating purchase prices, really any term of a contract, but a purchase price is one of those that's very easy to identify and quantify, obviously, as opposed to other less sort of number specific issues. Is don't let de minimis dollar differences kill a deal. And what I mean is, if you are $10,000 or $15,000 off in a negotiation, and it's a practice that you really think is good and you like, and it's going to fit your vision, and you've invested time and money into the process already, don't let that kill a deal. As with anything in the legal world or in the business world, don't get hung up on the principle of something. Just because you may end up paying $10,000, again, $20,000 more than you think it's worth, if you look at that over a 10-year period, for example, my $10,000 example, or even in this case, it's really more of a $20,000 example, you might only be talking about a difference of $2,000 or so a year in loan payments, which works out to be less than $200 a month. Well, if this is the right deal for you and you think you can do well in that practice, don't get hung up on a $200 a month difference. As I record this webinar at the end of 2017, it's definitely a seller's market out there. And if you're fortunate enough to find a practice that otherwise works, don't kill a deal for small dollars. You can find yourself a year from now still looking for the right practice. And oftentimes we will have clients that will make these decisions to abandon negotiations over small dollars and then talk to them 18 months later and they say, I really wish I had listened to you. I should have just bought that practice because I'm still looking for the right thing. So once there's a verbal agreement on some of the key terms of the deal, such as the purchase price, maybe non-compete, things like that. Oftentimes it makes sense to put those to paper in a term sheet or letter of intent, oftentimes referred to as LOI. And the LOI is going to spell out these key terms, such as the purchase price, the radius maybe on the non-compete, a lot of these details. So one thing you have to really be careful about is you don't want the LOI to be binding. What I mean is you don't want it to be contractual in nature. There's so many details that need to get covered in the actual purchase agreement, which can't be covered in the LOI. So you don't want to be obligated contractually obligated, that is, to purchase a practice if all of those details and contingencies are not included. So what type of contingencies are we talking about? Well, one that I'm giving an example for here, and we'll talk about that because I think it's an important thing in the transition globally, is you're always going to want a contingency that prior to the closing, the buyer is going to become credentialed as an in-network provider with any of the insurance plans that the seller accepts. Now, sometimes this can be a limiting factor from a timing standpoint because it could slow the closing down, as the credentialing process can oftentimes take 6 to 8 weeks or even longer to complete. But you would never want to purchase the practice and then have patients come in who used to have insurance accepted at that practice that then they all of a sudden have to go out of pocket. And it's a good way to scare patients away immediately after the closing at a key time when you're trying to transition the goodwill. But that's the type of thing that you also want to get in the LOI because that's a process that needs to start immediately, even before there's a signed agreement. Otherwise, it's going to slow down the timing with the closing. Something else that you're going to want to have in the LOI is the structure of the deal, whether or not it's an asset purchase or a stock purchase. An asset purchase is overwhelmingly the more common of the two in a dental purchase arrangement. Now, in an asset purchase, the buyer is only purchasing the assets of the seller, the good stuff, the goodwill, the equipment, patient lists. They're not purchasing any of the liabilities. In a stock purchase, however, the buyer is purchasing the assets and the liabilities of the seller. So they're essentially, as we say, stepping into the seller's shoes. Now, in this case, if there is a liability that predated the closing or this whole deal, and it's not something that the buyer was aware of, it could affect the value of the practice because now the buyer is responsible for that liability or that debt. Normally, these stock purchase agreements would have provisions that provide for what's known as indemnity. It means that the seller would cover the buyer and reimburse them if they picked up those liabilities. But oftentimes the seller may not have the assets or the ability to do that, and that could be a problem. If certain liabilities exist that the seller is going to expect the buyer to take on, they should be reflected in the purchase price, and that's something that you really need to account for before the closing, because if it comes up after and the buyer didn't know about it, then chances are they've overpaid for the practice. A stock purchase, again, is much less common, and it's also a lot less advantageous to a buyer from a tax perspective. And for that reason, again, a purchase price in a stock purchase structured deal is going to be lower than it would be if it's structured as an asset purchase. So again, subject that you really need to work with your CPA and your lawyer to make sure that the deal is structured properly. Once the parties have signed off on the LOI and it's time to move to the next step of the transaction, which is preparing and negotiating the agreements, that's usually a good time to think about forming the entity that's going to own the practice. So usually that's going to be a limited liability company or a professional limited liability company, which most states allow that designation, and those entities are commonly referred to as an LLC or a PLLC. The actual formation of the entity is a pretty simple ministerial process. It's usually like a page or two document that gets filed with the state, and then the entity exists. However, in addition to filing the document with the state, an entity is also going to need what's known as an operating agreement. And an operating agreement is essentially just a partnership agreement. It sets forth what the partners' responsibilities are to each other and to the LLC or the PLLC. Now, if there's only one member or one person, one principal for the buyer that's going to end up operating the practice, this document is a very straightforward form. and it's not obviously negotiated. However, there are a lot of issues that can come up if there are multiple partners that need to be tackled and provided for in the operating agreement. And we always counsel our clients that good planning and preparation at that stage can really help to stave off partnership disagreements and disputes down the road. The more difficult issues you tackle and discuss at the inception of a partnership, generally the better off people will be in the long run because both parties understand what they're supposed to do and not do, and that gets captured in the actual agreement. Also part of this process is to obtain an employer identification number, or EIN, and that's essentially a tax identifier that's necessary for the lender, your bank, and also to start the insurance credentialing process. They're going to ask for that number. In addition to that, you're going to want to work with your CPA on tax elections. So there are certain tax elections and decisions, what I mean, or choices that you have oftentimes depending on the type of entity and the number of partners that are involved. And it may be more or less advantageous to elect to be taxed a certain way. So again, throughout the process while you're working with your CPA, this is another thing that you want to discuss with your CPA. What type of tax election should we be making for our entity? So now we're on to the fun part for us. This is the actual preparation and negotiation of the agreements. So something to keep in mind at the outset is it's really important for the purchaser to have their attorney prepare the initial draft agreements. What I'm talking about is the asset purchase agreement, seller's post-closing employment agreement if the seller's going to stay on for some period of time after the closing. And there's a misconception that we often hear from clients where they think that it might be cheaper or better if the seller's lawyer prepares the initial draft agreements, and that's simply not the case. The buyer is the one that needs more protection in these transactions, and obviously the seller and their lawyer are not going to provide for all those protections in the agreement that they generate. And when you work with a dental-specific lawyer who does these transactions a lot, they have their own forms. They're comfortable with them. They don't have to read every word. It's their own document. They've seen it hundreds of times. As opposed to when if a seller's lawyer prepares it, then your lawyer, as the purchaser, is going to have to review all these documents carefully, propose edits, and oftentimes, it can be much, much more expensive to fix somebody else's bad document or deficient document than it is simply to use a good version of first draft that's something that would be acceptable for the purchaser. The other thing too is to be aware of and be careful about is don't let non-lawyers, brokers or consultants prepare agreements. There's a lot more to it than just the templates and the forms. Obviously, lawyers start with forms. They don't start from scratch and reinvent the wheel every time they generate an agreement. However, that's only the beginning of the process. How you fill that in and how the whole document comes together is different from deal to deal, and that's where it's important to be working with a professional that can guide you through that process and make sure that your agreement is custom tailored to your particular transaction and your needs. Now, what type of things can you expect to be in the actual purchase agreement? Well, obviously, the purchase price will be in there, but also that purchase price will contain what's known as an allocation of the purchase price. And this is, for tax purposes, different components of the assets get broken out and assigned a value. So an example might be the equipment versus the goodwill versus the covenant not to compete. And each of those gets a separate line item for what value is assigned to those in the deal that make up the purchase price. And there are tax consequences to assigning certain values to certain aspects of the assets. And as with most things in the tax world with buyers and sellers, generally what's good for the buyer is not good for the seller, and vice versa. So it's important to work with your accountant once again to make sure that the allocation of the purchase price is done fairly, and so that you don't have any surprises after the fact and end up paying taxes where you shouldn't necessarily need to. The agreement's also going to list the actual assets being transferred. So you're going to list the hard assets, the equipment, those types of things, but also websites, telephone numbers. Now social media accounts are very important. You want to make sure that you have access to those social media accounts and for the website, so that you are able to use those things and continue on through the transition, just like the seller had prior to the transaction closing. In addition to having a list of assets being transferred, there's also a list of things not being transferred. So sometimes, and normally those things are personal items of the seller, diplomas, certain artwork, maybe special items, and occasionally the seller may have a particular piece of equipment that maybe they've leased or they've borrowed, and that's not going to be included in the deal. And you want to know that so that you realize and are able to get all of what you think you're supposed to be getting in the deal. The agreement is also going to contain what are known as representations and warranties, or commonly referred to as reps and warranties. And these are sort of promises and statements that are being made by the seller that the purchaser is relying on in purchasing the practice. So some examples of those would be that the financials that have been presented to the seller are the financials that are presented to the buyer are accurate and correct. You would also want to know that there's no pending litigation that could affect the practice's assets and the value of what you're actually paying for. This next thing that you're going to want to include in a purchase agreement is very important. It's restrictive covenants. So what we're talking about here are non-solicitation covenants, which is a prohibition against the seller's ability to solicit patients, employees, referral sources after the closing, and then also covenants not to compete, which is a prohibition against sellers' ability to practice a certain distance from the practice for a particular time. So generally speaking, we like to see 5 years as a minimum in our agreements when we're representing buyers, and then the distance really depends on the area and the region where the practice is located. So if the practice is located in an urban, densely populated area, that distance is going to be less than if the practice is located in a more rural area. And again, this is a very important concept and something that absolutely needs to be in a purchase agreement, because most of what a buyer is buying when they buy a dental practice is the goodwill of the practice. And the only way to protect the goodwill, i.e. the patient base, is to prevent or prohibit the seller from being able to continue to treat those patients after the closing. You never want to pay a lot of money for a practice only to find out that the seller is now able to open up shop down the street and see patients there, and you lose patients, and now you've paid for something that you didn't get. The agreement's also going to contain contingencies, so certain items that have to occur in order for the buyer to be obligated to proceed with the purchase of the practice. And some of the important contingencies revolve around the real estate. So you would want a contingency that if the real estate is being purchased along with the assets of the practice, that the practice does not have to be purchased unless the real estate purchase comes to fruition. If the real estate is not being sold in connection with the deal, then you're going to need some sort of lease for the property. You would never want to buy a practice to find out that after you've paid top dollar for it, that there is no lease and you have to relocate the practice to another location, which can be a very expensive process. But this is what's known as a third-party consent. So you have to get the approval or negotiate with the landlord for the seller, and it's really important to jump on this right away, because it can delay the deal. because the landlord doesn't necessarily have any stake or any interest in this deal coming to fruition. So sometimes they can delay or be difficult. And so that's always something that's important to jump on right away to make sure that the lease can be assigned or that a new lease can be negotiated and entered into for the practice. So, and this is something that the buyer's not going to want to sign that lease, obviously, until the rest of the deal closes. And at the closing, this is something that you would sign the actual lease for the office as well. Some specific lease terms, the lender for the buyer is going to require, generally speaking, at a minimum, that the lease term is the same term as the practice loan. So if you're getting a 10-year practice loan, you would expect that a lender would require you to have a lease with at least 10 years of term, because banks don't want to lend money to only find out that their borrower has no place to practice, and obviously makes it more difficult to pay a loan if you don't have a office for your dental office. There are a whole number of topics that you need to be aware of and address when it comes to negotiating a dental office lease, and we could do an entire webinar on that topic, but just to briefly go through and summarize some of the things that you need to be aware of and look for, because when you're either evaluating the seller's lease that you're going to assume or negotiating a new lease with the landlord in connection with the purchase of the practice, there are certain dental specific things that are important to get into these leases. So one of those is the automatic assignment in connection with the sale of the practice. And what this means is that the lease provides that you can automatically transfer this to someone who's going to buy the practice down the road, so that the landlord doesn't have the right to veto that assignment, which would effectively veto the deal. Relocation provisions can be bad in leases. What that means is the landlord has the right, oftentimes in commercial leases, to move their tenants to a different location in the shopping center or the building. Obviously, for a dentist, that can be a really bad thing, given the expense of actually building out an office. Another thing that you might want to try to get is exclusivity for dental. So that you don't have competition in the building or in the center. You want to make sure, as we talked about a few moments ago, that the term of the lease is sufficiently long for your purposes and for your lender's purposes. Option terms. So this is at the end of the lease term, you have the ability to renew or exercise an option to continue the lease for a certain period of time. You want to make sure that there's a formula that's in place. What will the rent be during those option periods? And then lastly, sort of the big topics to look for are personal guarantees. This is you're going to be responsible personally for the obligations of your practice, your LLC or your PLLC with a lease. So best practice is to limit those so that they don't go on forever, or that the amount that you're actually guaranteeing is limited as well. And again, these are things that you want to look for when you're looking at the seller's lease, or things that you want to ask for if you're negotiating a new lease with a landlord, or even in the case where you're accepting an assignment of the seller's lease, you still have the opportunity at that point to negotiate or try to negotiate certain improvements or revisions to or amendments rather to the seller's existing lease. And it's important to really keep your eye on the ball with that. As I said a few minutes ago, a dental office, there's a reason why it's called a dental office. Without an office, you don't have a dental office. So you have to be very mindful of what's happening with the lease and your ability to actually control that space and what you can and can't do and what others can and can't do around you. Some other contingencies that you're going to want to provide for in a purchase agreement or financing. Obviously, after you sign the agreement to purchase the practice, you want to make sure that it's contingent on your ability to get financing. If you can't get financing to buy the practice, you don't want to be contractually obligated to proceed with the purchase of the practice, such that if you don't, you would get sued for breaching the contract. So there would be a provision in there that should say the closing of the practice is contingent on the buyer obtaining financing, and if the buyer doesn't get financing, then this agreement shall terminate. Sometimes the seller's not willing to agree to that, though that's a very small minority of the time, because the reality is without financing, most dental practices are not able to be transitioned. If the seller is staying on as an associate after the closing, you're going to want the employment agreement for that seller to be a contingency, and that employment agreement would actually be a negotiated document that is attached as an exhibit to the asset purchase agreement, so that agreement gets negotiated at the same time that the purchase agreement is getting negotiated. Also, you'd want to provide, as we talked about a little while ago, for insurance credentialing. You don't want to purchase the practice if it's a PPO practice and not be an in-network provider with the practice patient's insurance. Some more things that you're going to want to see addressed in the purchase agreement are how will the accounts receivable be handled? Will the seller be collecting their own accounts receivable, or will the buyer be responsible for collecting the seller's accounts receivable? Typically, if the buyer is collecting the seller's accounts receivable, the buyer would charge a fee of some certain percentage, 10% for example, to collect that. And the reason why that's a good thing for the buyer is then the seller doesn't have that communication with the patients after the closing. The buyer now has that relationship. It's easier to avoid issues and misunderstandings as to balances and how much patients owe, if the buyer is responsible for keeping track of that stuff. There may be transition assistance provided for in the agreement, so that's the seller staying on and helping the buyer kind of learn the ropes of the practice, make introductions to patients, and just get them familiar with things. And the period of time that lasts, really varies from deal to deal, and depends on the size of the practice, how long it's reasonable to expect the seller to stick around after the closing. Defective work and work in progress. How are we going to deal with treatment that needs to be redone by the buyer after the closing? So even though the buyer's probably not going to be responsible for the seller's defective work, this is all about transitioning goodwill. As a buyer, you don't want to tell a patient, sorry, that was the old guy that did that bad work, and now I'm going to charge you to correct that person's bad work. Regardless of the fact that it wasn't you, that patient's probably never going to come back to that practice. We also want to know, how to deal with work in progress. If there are certain things that the seller has been paid for, but the work hasn't been completed, such as crowns, is a typical example. You want to schedule those out to make sure that the seller is either going to give the buyer some sort of credit for that, or that the seller is going to finish that work after the closing without additional cost to the patient or to the buyer. The agreement should also provide for indemnification. And what indemnification means is that the parties agree to cover the other parties, essentially insure them, to protect against them, to reimburse them, essentially, for anything that comes up that was not that other party's responsibility. So if, for example, there is a lien on a piece of equipment and the seller has represented that there are no liens and that lien is for $30,000 and the buyer discovers that after the closing, then the seller would agree to pay the buyer $30,000 to cover them for that mistake, essentially. That's an example that may not be the best example from a practical standpoint, because those types of things should be discovered and researched in the course of the negotiation process, and also at the time and after the agreement is signed. So if liens exist, they should be dealt with before, but it's an easier example to give you than just something else that's less tangible. And then finally, something you'd expect to see is obviously the closing date. When the agreement is signed, the purchase agreement is signed, oftentimes it's not signed at the time of the actual closing when the transfer actually occurs. It's sort of like when a house is being purchased. You sign the agreement of sale and then you go to closing at some period of time after. So the date of when this closing is going to occur will typically be in the purchase agreement too, and it should be. And finally, we get to the closing, and this is the actual transfer of ownership of the practice occurs here. And typically, it's a pretty smooth process, or at least it should be. You'll find that after months of going back and forth and dealing with all sorts of things and issues and trying to line things up, that one day it just ends. It is somewhat anticlimactic oftentimes. But in order for it to be a smooth process, it's important that all the necessary preparation has happened and things have been coordinated. So we have to have coordination with the bank who's delivering the money for the purchase, the landlord who is going to be signing off on the lease, the documents that have been signed previously, the asset purchase agreement, contain employment agreements and other things. They might get signed and delivered at the closing, and all these things get exchanged. It used to be that everybody sat around a table and exchanged these documents, but now most closings happen what we refer to as electronically, and that means by email or by fax, and attorneys exchange documents that way instead of people sitting around in a room, which is frankly a lot more efficient to do it this way. And I've always found that when everybody sits around in a room, it takes much, much longer, and also more issues oftentimes come up. And this will conclude the presentation. Thanks for listening, and best of luck on your path to practice ownership.